Hi. The first illustration video associated with revenue recognition will be the most straightforward, and that is recognizing revenue at a single point in time. So the transaction is dictating that revenue recognition will occur at a single point in time. So this is revenue recognition for a sales contracts satisfied at a single point in time. Revenue is recognized when all the performance obligations are complete. Again, an example here is a sale at a retail outlet. Now, a little more to add to the core revenue recognition principle in terms of the putting it into practice. Here's 5 indicators that transfer of control of the asset has likely been passed to the customer. Remember, that's one of the criteria for revenue recognition, that the performance obligation is complete. 1, the customer has an obligation to pay the seller. 2, legal title has passed to the customer. And of course, any or all of these may be present in the particular circumstances of a sale. 3, physical possession passed to the customer. That's an example, for example, with the broom that you walked out of Target with after you paid. The first one, the customer has an obligation to pay the seller. That's when you've taken the broom and said, I'd like to purchase this, and you go to the checkout counter. Legal title passed to the customer. That one might occur at a selling a automobile to a person. The customer now has the risks and rewards of ownership is another indicator that transfer of control of the asset has likely been passed to the customer. Finally, the customer accepted the asset, which is evidence that the customer is satisfied. Okay, so let's look at a case for revenue recognition at a single point in time. Peloton Inc. sells high-end treadmills for $4,000 and high-end stationary bicycles, exercise bicycles, for $3,000. The fully absorbed cost to manufacture each treadmill is $2,000. So they sell it for $4,000, they manufacture it for $2,000. And the fully absorbed cost to manufacture each stationary exercise bike is $1,500, half of the sale price, $3,000. Okay, so that's information you need to know. And now a transaction occurs. On December 20 of 2023, the fitness outlet ordered 1 treadmill and 1 exercise bicycle that they will offer for sale in their retail store. Now, the paperwork was fully completed on December 20th. According to that agreement, the fitness outlet must pay Peloton for the equipment within 30 days after delivery is completed. In the new year, on January 2, 2024, Peloton delivered the treadmill and the exercise bicycle. The receiving document signed by the customer was immediately emailed to the accounting department. On January 25, 2024, well within the 30-day requirement, 30 days after delivery, payment must be submitted. Well, on January 25, or 23 days following delivery, Peloton received a $7,000 check from the fitness outlet in full payment for the treadmill and the exercise bike. So the requirement is simple here. Show the journal entries that Peloton will record associated with these sales. Importantly, include the date that the journal entry will be recorded. Okay, now as always, please pause this video and work this. Work this case. Welcome back. I hope you had success. Let's look at the solution now. Remember, the key here is that the agreement between Fitness Outlet and Peloton was agreed upon. The sale was agreed upon on December 20 of 2023. The goods were delivered to Fitness Outlet on January 2, 2024, and Peloton received the $7,000 check from the Fitness Outlet. Okay, so the requirement is to do the journal entries. What we're really talking about here is, when is revenue recognized? We certainly know what we're going to do on the 25th. We're going to debit cash and credit the accounts receivable. So the real questions in this case are, when is accounts receivable truly earned? When is that money due to Peloton? And then, therefore, what's the related sales revenue recorded? Okay. And obviously, the candidate dates really are either December 20, 2023, or January 2, 2024. December 2023 is when the paperwork was fully completed. December 2, 2024 was when Peloton delivered the exercise bike. Okay. And let's also review those 5 steps. Identify the contract with the customer. Can be implicit or written. Identify the performance obligations in the contract, and then determine the transaction price. Okay, so the transaction price is $7,000. Step 3 of revenue recognition, the core revenue recognition principle, is pretty easy. Step 1, identify the contract with the customer. Okay, that one's pretty easy too. Peloton, we deliver you a functioning treadmill and a functioning exercise bike to the standards we warranted they would be. And then Fitness Outlet accepts them for sale to their customers. So the performance obligations are deliver a well-functioning good and then accept it. With that in mind, there's actually no journal entries on December 2023. A very relevant date, make no mistake about it. But Peloton has not completed its performance obligation under the contract. Hence, it does not have claim to an account receivable yet. Now, a lot of activities will be initiated in preparation for this. We now have the purchase order, or I'm sorry, not the purchase order, the sale document, and then we send that to fulfill it. So that we send that to our warehouse so they can deliver it and schedule the delivery. And once that's done, we will deliver it with an invoice to pay, because then the company, Peloton, has earned the sale. So on January 2, 2024, we earn it. We deliver those as soon as the receiving document is emailed to the accounting department will say, okay, now we've done our performance obligation, and excuse me, and the first thing we'll do is recognize the sale of the treadmill for $4,000. To record the sale of fitness equipment is my explanation on it. And again, remember, we have the debit here is a plus to an asset, increases an asset account, accounts receivable, and the credit increases a revenue account, which also increases the balance sheet stockholders' equity. Now, remember, we also have to record the cost of the goods sold, the treadmill sold. And so here we have plus expense plus stockholders' equity, and a reduction in assets, the inventory. So our net profit on the sale of the treadmill is $2,000. And then similarly, there's the exercise bike sale for $3,000, and then the cost of the bike sold was $1,500. And that is our entries on the day of the sale. So the only thing that's different here than we talked about the example of a sale of the coffee at Starbucks. Well, as soon as you accepted the coffee and found it to your liking and drank it, the company is able to debit cash and credit the sales revenue for the cost of the cup of coffee. So that was also a point in time, but it was the date of it was more obvious. It was kind of an immediate as soon as you accepted the coffee. Similarly, with Target, as soon as you walked out with the broom you purchased, or really as soon as you paid for it and got to the door, they can debit the cash or the accounts receivable. Well, debit cash because people will either pay with cash or a credit card. And credit sales revenue. Right. So that's point in time. And the only thing we have left now is on the date that cash is received, the Peloton will debit cash and credit that accounts receivable to zero it out, because we no longer have a claim to money. We have the money itself. And that is performance revenue recognition with a performance obligation recognized and earned, and therefore the revenue earned at a point in time. Okay, thank you for your attention. Excuse me. We'll now turn our attention to revenue recognized over a period of time in the next illustration.